Welcome back to the Dividend Diplomats YouTube channel, everyone. Got your boys here, Lanny and Bert, the Dividend Diplomats. Lanny, we've got something exciting for the viewers. We are going to feature a format of a video we have never done before on this channel. So guess what, everybody? Buckle up. We are going to talk to you about some dividend stocks in a lightning round today.
Subscribe to this channel, guys. Hit that red button. Give us a thumbs up. Takes 2 seconds for all the wrestling fans. This might be the fatal four-way. Could call this the king of the ring as we pit a bunch of dividend blitzes here for you guys. Head-to-head quick matchups to see which one is the better stock out of the two. And are we buying the winner? Yes or no?
Absolutely right. So what are we going to do here? We're not going to dive into the earnings releases. We're not going to look at the noise in the market around them. We're going to focus on the metrics head to head and give the two criteria that Lanny was saying. Which one we like better? And are we buying that stock? So how are we going to evaluate them? We're going to run them through the Dividend Diplomats Dividend Stock Screener, featuring 3 metrics and 1 bonus metric: price to earnings ratio, payout ratio less than 60%, history of increasing dividends, and that bonus metric, the dividend yield.
All right, Bert, let's time to get after it. We got 4 blitzes here, 2 stocks in each category that do face each other in the ring occasionally or often, almost daily. So let's see, what's that first roundup here, brother?
Yep, our first matchup today, we're going to go to the soft beverage industry. We're going to take the 2 titans of the industry head to head. We're going to talk Pepsi, and I'll take those metrics. Lanny, you can take the Coke metrics, and we're going to see how it goes along here. So let's run Pepsi through the screener, and then you take it away there for Coke. What do you think? All right. Pepsi, PE ratio after their current price 182 is 24.89. Their payout ratio is 69%. 5-year dividend growth rate is 7.12%. 50 plus years of increasing dividends. Dividend king with a yield of 2.78%. Lanny, hit the people with Coca-Cola.
It's going to be hard to beat, guys, but Coca-Cola, ticker symbol KO, the Warren Buffett loving stock right now, $60 share price. PE ratio right now is 22.99, less than Pepsi. Dividend payout ratio pretty close to Pepsi at 70.5%, above that 60% threshold. 5-year dividend growth rate about half of Pepsi, unfortunately, at 3.48%. They got Pepsi beat in the dividend growth streak at 60 plus years. Now with the dividend yield of almost 30 basis points higher than Pepsi, or at least 10% higher than Pepsi, at 3.07%. Oof.
Interesting. All right, Lanny. So let's have you answer the question first. Which one do you think is a better value, and are you buying that stock?
Well, guys, I think Pepsi is overall the better company just because of the diverse brand portfolios that they each have. I am not buying either, though.
I agree. I'm going to pick Pepsi and buying neither. All right, that was our first dividend stock. All right, so let us know, everybody below. Pause right here. Keep track and put your posts here of these answers to these questions. Do you like Pepsi or Coke as we're going through this? Number 2, we're going to take that second analysis here. We're moving to a highly talked about sector right now, the large super mega store sector. We're going to talk about Target versus Walmart and run them through our screeners, everybody. Lanny, I'll take Target. You take Walmart if you're cool with that, Chico.
Let's make it happen, Kevin.
All right. Target's PE ratio is 15.75 after their close price of 131.16. By the way, everybody, the link above, we just talked about Target on our channel. That was our last video, so make sure you check that out. Target's payout ratio is 51.86%. 5-year dividend growth rate is 11.74%. They've increased that dividend for 54 years with a yield of 3.29%. Lanny, tell us about Walmart.
Not too bad, guys. All right, time to bring out good old Walmart. Ticker symbol is WMT, everybody. They're trading at $147.41 as of the close of June 1st. P ratio is quite a bit higher than Target, though, right now at 23.7 times earnings. Sliding into that second base, that dividend payout ratio. Definitely lower than Target's at 36.66%. So plenty of room to grow and pay the dividend. But the question is do they? Well, they do, but they do by a small margin. increasing the dividend for 49 plus years, almost a dividend king as well. 1.87% though is on the growth rate, following that up with a low dividend yield of 1.55%.
All right, so I can give the first answer this time. To me, which stock's the better value? Target. Am I buying Target? Yes. I haven't bought them yet, but they are very high on my watch list, and I would definitely grab them at this price. What do you think, Lanny?
Yeah, Target takes the cake, guys. Let us know in the comments below which one do you take, by the way, as we're doing this. Don't get to our answers. Let us know as we're battling. And I do like Target at current prices. They are high on my watch list. Missed them on June 1st, actually, this morning. They actually dipped that down to 126. So missed them because I would have grabbed a share there for sure.
The next dividend stock, quick showdown, lightning round, whatever we want to call it, had the big oil. The two largest integrated oil companies, Exxon Mobil and Chevron. Exxon, ticker symbol XOM, Chevron CVX. I'll knock this out. I'll start with Exxon's metrics. PE ratio at their current price of 103, 1037. Payout ratio is 36%. That dividend growth has been terrible, 2.89%, but they held on to their dividend aristocrat status. Barely by a thread they hung on. They've increased for 40 years, and their yield is a solid 3.52%. Lanny, how's that stack up against Chevron?
Chevron, ticker symbol CVX, guys, trading at $152.16, saying, hey, Exxon, hold my beer. Trading at 10.7 times earnings, so pretty close to Exxon. 42.5% dividend payout ratio, a little bit higher than Exxon. Dividend growth rate, though, is 2 times what Exxon does at 5.90%. Doing it for 35 plus years. Again, also a dividend aristocrat. And the yield's actually slightly better at 3.97% right now.
Interesting. So do you have any thoughts on this one, Lanny?
To me, Chevron is not the clear winner, but I would call it the winner, just because, overall they've persevered better than Exxon. They kind of performed better than Exxon during bad times, and they've proven that recently. Obviously, past performance isn't indicative of future performance, but and I'm just not buying oil though right now.
I would agree with that. I would pick Chevron, and I'm staying away from oil. But interestingly, both companies are showing signs of valuation too, so it's something to consider. Again, make sure you let us know, Exxon or Chevron, as you're going through your matchups. Let's round this puppy out here in our fourth and final showdown here. We're going to the heavy construction. We're throwing a little curveball here. We are talking Caterpillar, ticker symbol CAT, versus John Deere, ticker symbol DE. All right, I'll start this off with Caterpillar. At their price of 209.07, their PE ratio is 11.73. Annual dividend is 480. That gives you a payout ratio of 26.94%. Their 5-year growth rate's 9%, and they've increased that dividend for 29 years. Yes, they are a dividend aristocrat, everybody. Their yield isn't that high, though. It's at 2.3%. I'm interested to see how John Deere stacks up.
Good old John Deere tractor, guys. Now, again, kind of similar products, but sometimes not, so definitely in the similar industry, though. Trading at $352.57. Holy smokes. That price to earnings ratio is actually lower than Caterpillar's, despite a much higher stock price at 11 times earnings right now. Sliding into that dividend payout ratio, even lower than Caterpillar's 26%. They're at 15.69% on the payout ratio for John Deere. And it makes up for it. And it makes sense, too, because they grow their dividend at an average rate over the last 5 years at 14.44%. Wow. Now, according to the websites, obviously they don't grow it every single year, but they have been consistently growing it for 2+ years. They sometimes take a cooling off period depending on the number of quarters. But the yield is smaller than Caterpillar's at 1.42%.
So interesting here. Interesting. If I was going to pick one, it's the slightly more expensive stock, but I would lean Caterpillar right now. You know what? This might be one, not buying it today, but this one might definitely be shooting its way up the watch list. It's interesting that it's down almost 13% year to date at the time of this video.
Yeah, just yesterday, cat stock actually was on my radar because I think at one point they were in the 205s.
Yeah.
And I thought that was pretty interesting just because their 52-week high is $266. So they're down $60+ almost at one point yesterday from their 52-week high. But what do you guys think,
Mhm.
about Caterpillar or John Deere? Which stock would you rather buy? And do you see value in either of the two?
Mhm. 3, 2, 1. So there we have it, everybody. That is going to round out our 4 dividend stock showdown lightning round. We still haven't thought of a name of it yet. Give us a comment below if you have a good name for this. Also, let us know what you think of this format, and more importantly, let us know what you think of these 4 matchups and which stocks you liked in each one of them, head to head.
We might have to ask Jim Cramer or CNBC for the lightning round.
Yeah, so we probably won't call it the lightning round then. Inspired by the lightning round.
Yeah, let
Yeah.
us know which stocks you're buying out of this list. Remember, guys, we got the beverages. We've got the agriculture slash building slash demolition, companies here. We've got big oil. And of course, we got big retail. Let us know in the comments below if you guys also want to see us do more of these dividend blitzes. Again, lightning dividend battles. Let us know in the comments.
Hell in the Cell. I don't think WWE would license that one to us either. If you haven't already, subscribe to the channel, everybody. Give this video a thumbs up. And just remember, if you're not with us, you're against us.
That was Bert and Lanny from the Dividend Diplomats, over and out.